go over some of my guidelines that I've set forth on setting up a short straddle. It's not just going out there and putting a short straddle on any given time where you think the underlying is going to trade sideways. We need to have some specific guidelines in order to set these strategies up, turning that table into our favor here. As I said, my name is Eric Wilkinson. You very well may recognize me from mainstream media, where I've talked about everything from the economic to geopolitical market analysis. I do the same thing in my daily market commentaries. I started trading in college with some money I'd earned, switched over to finance, and after graduating and trading in college, I moved to Chicago to work on the floor, traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products. Again, we're going to be doing the short straddle, but I want you guys to take this and shelve it for a moment, as we are going to be leading ourselves to finding the short straddle like we would do on any given day. The deal is I want you guys to learn these guidelines in order to set up a strategy, but we don't start out a day going into the day thinking, I need to put on a short straddle today. No, we don't do that. We go and we start looking at charts, or maybe you get a mailer or something like that, and they give you some ideas. Well, at the end of the day, once we've come up with an assumption around an underlying, then that's what leads us to finding the right strategy. So in this, what I want you guys to forget about is we're doing a short straddle here, but the idea is I've looked at the charts or whatever and found something where I think that we have a market neutral assumption, or I believe the underlying is going to trade in a relatively tight range for at least the foreseeable future, the next 2, 3, 4 weeks down the road. I'm not talking a year down the road, but the next couple of weeks. So what we're going to learn in this today is direction. Once we have our directional assumption, then we need to look at that underlying and see if it is option worthy, if we can trade options around this. And I'll give you guys some details of that in a little bit. And the environment is probably one of the most important aspects of what we're looking at. Are you guys getting the change in seeing this page here? That on the duration? Let me know if this thing gets stuck on some pages. I'm trying to keep my eye over there. But and the duration, what's the duration that is going to be optimal for this given underline or this given strategy? Also, we're going to talk about the strike location, why I picked the strikes that we're looking at, and I'll give you a good reason as to why and a way to remember that. All right, so delta. Delta is just data, and we're going to go over these Greeks really quickly, but I'm going to give you guys some easy ways to remember it. Hopefully your minds aren't just blown away right now and thinking, oh my God, we're going to talk about Greeks this whole time. No, what I'm going to do is give you guys some easy ways to remember what the Greeks are. And delta obviously tells us the definition. By definition, it affects the options premium, the underlying strikes, in relation to how the underlying moves. And all of these Greeks are the assumption that we're moving forward. $1 higher, Vega's 1% higher, Theta's a day goes by, right? So another thing that delta tells us is data. Just remember, it's data. It not only affects the options premium, it also tells us the probability of being 1 penny in the money at expiration. So every strike tells us that probability of being in the money by 1 penny, okay? Also, we can talk about it. Well, I'll talk about some other things of the data aspects that it gives us. So when we're looking at an underlying, it's XYZ, right? I need to know how my premiums are going to be affected. And here is the delta column right here, all right? And we talk about $1 move in the underlying. It affects it in relation. So we've gone from 148.35 to 149.35. So we just increased by $1, all right? And that's what we're basing our delta off of. That would mean that these strikes that are right here at the money are going to, when this underlying moves up by $1, my premiums are going to move up by 45 cents for that 150 call. On the flip side, if we looked at the 145 put, right, the underlying moves higher by $1. Well, we notice over here in the delta column for the puts that those deltas are negative. That means that if the underlying moves higher by $1, then our premiums are going to move down by 38 cents, right? Now, basic math sticks to this. If we were to move down by $1, well, think about it, down by $1 plus a positive delta would make that a negative delta. On the put side, down by $1, a negative plus a negative makes that a positive delta. So if we were on a downward move, those 145 puts here would then increase by that 38 cents, okay? Because a negative dollar plus a negative delta makes that positive, so we would add in. On the flip side, if we move down by $1, this would become a negative delta. So a negative delta to my premiums would, the money would come out, right, on a downward move. Pretty basic. And then we go over and we talk about gamma. Easiest way to remember gamma, gamma just goes with delta, all right? Gamma goes with delta. And that is, when we're talking about, this was on the first dollar move, this dollar number 2, this is dollar number 2 down here. This dollar, or sorry, delta's dollar number 1, gamma's dollar number 2. So now we're talking about being at 150.35, right? So this is a positive delta. So we moved up by $2. The first dollar move higher, our premiums increased by that 45 cents. So we would have been at like $4.05 here and $4.20 here. So that was on that first dollar move. Now we're on dollar number 2. So now gamma goes with delta on that second dollar move, and it would be 48 cents here. So then we would be talking about $4.53 and then $4.78. Okay, because now it increases by that 48 cents because gamma goes with delta. Oh, sorry, 68 cents, $4.68. All right, so that second dollar move higher, gamma goes with delta and it adds in there. Over here, that second dollar move higher, gamma goes with delta. Now that second dollar move higher, our premiums would decrease by only 35 cents, right? Because a negative delta plus a positive gamma makes that subtract out. So it would only be 35 cents coming out of those premiums on the put side. Flip side, you go down by $2, right? We've got a now positive delta to our premiums, and then the gamma would add into it. All right. All right, theta. Theta is our thief. Theta is the thief in the night. So every day that goes by, theta comes in and steals some money out of your pocket, all right? It's the pocket thief. And so every day he takes money out. Further out in time, you know, those 365 days to expiration, theta is not very aggressive. But inside of, you know, basically 7 days, he gets really aggressive. But inside of 35 days, that's the wheelhouse that theta starts picking up some momentum, starts really coming in and starts getting aggressive. And every day that goes by, he steals more and more and more every single day. The amount he steals is more. So he might take 6 cents, then the next day he takes 7 cents, okay? So he's getting more aggressive the closer to expiration. Further out in time, that theta is limited. So when theta comes in, we look at this every day that goes by on these options to expiration. On the puts and the calls, you can see it's negative. Theta is always negative. Why is theta always negative? Because you can't go back in time. So every day, theta comes in and steals some money. And inside of this 36 days to expiration or 35 days to expiration, that's where it really starts picking up some momentum. Way out in time, a little bit less aggressive, like I said. But so tomorrow we could wake up and see that those premiums are going to decrease by 6 cents. All right. And that is, you know, with everything else being equal, volatility doesn't change, the underlying doesn't move at all, but we just see that theta come and steal some money. All right, Vega is the only one that's not a Greek. I have a Greek letter there, but it is not really a Greek in real life. In option life, it is. But Vega is just volatility. all right? And it's implied volatility, which is forward looking. That's what we always want to look at. And it measures the change in volatility in relation to what our underlyings are as well. So we can always see that Vega is positive. The assumption is volatility moves forward or moves higher. So we're talking about a 1 percentage point. We're talking about like increases in Vega, all right, which is just a implied volatility, all right? It is a percent, but I don't want to confuse you on that. All right, so that's saying we're going to go to 27.57, okay? So it's increased by 1 percentage point over here. That means all of the premiums are going to increase by their corresponding amount on Vega. And please discount that. That has to do with the bid offer getting wanky. But you can see here, if it increased by 1 percentage point, these premiums are going to increase by that 18 cents on the 145 puts, and on the 150 calls, you can see that the premiums are going to increase by 19 cents. So that's if the underlying doesn't move. We're isolating it and just get a percentage move higher. Now, you guys might be looking at it like, hey, 19 cents isn't a big deal. Well, volatility moves in more than one increment at a time, all right? And I'm not talking about the VIX. What I'm talking about is this particular underlying volatility, all right? So it can move up and down by 5 to 10 percentage points on any given day. So that's why it's really important to look at that, because you can say that if it increased by 10 percentage points, right? Well, our premiums would have, all else being equal, nothing else happened, would increase by $1.80. All right. So that's a big deal. I mean, that's, turning the tables in your favor and, determining whether or not you'd be profitable or not profitable in some regards. If you guys watch the daily market commentaries, you guys saw just this with Amazon the last few days. I only had Amazon for a couple of days. I had that theta component really in full steam. I also had volatility come out a little bit from my premiums, and I was able to get out of a trade in rather just a couple of days. I didn't get my directionality right. I was bullish on it. It really traded pretty much sideways, when you're looking at the charts. So with that being said, even today with the market moving down against me, those puts, came into fruition. So I was able to get out of them. All right, so let's get on with it. Where are we going? Right now, what I want to talk about is I've got a market neutral stance, and I'm saying I'm going to go to XRT. All right, so this is where I want to go, XRT. And what I need to understand is, I actually want to do XLK. Sorry, I want to do XLK because I want to do the tech sector. So let's just change it. I'm going to do XLK. And it really doesn't matter where we're putting that on the screen. But what the underlying is going to determine I am market neutral in XLK. I can give you guys a brief synopsis of why I think it is. I don't think anything's really going to happen anytime soon. Yes, it could pop on, some stocks could pop on some stimulus, all right? There could be, sways on, where the election's going to go. That could drive the market. I can give you a bullish and bearish assumption. Gosh, I've got marbles in my mouth. For either candidate, I can give you a bull assumption for Trump and a bear assumption for Trump. Same for Biden. Okay, so ultimately, the bulls and the bears, it doesn't matter who's battling it out right now. We are going to kind of counteract one another, and I think the market neutral stance is a pretty safe bet, at least for the next couple of weeks. And if I can see volatility come out of this underlying when it's just trading sideways, that will help me. So I've got a market neutral assumption. I'm going to XLK, all right? And let's just say we're starting out here. So pretty much a market neutral assumption going across there. So I've got a neutral assumption. I think it's going to trend sideways in the markets. So I need to figure out, is the destination a good thing to go to? Is this area for XLK a good spot? What I mean by, is it a good destination? Is this underlying having a lot of volume and open interest? Open interest, the key, right? Because when there's a lot of open interest, there's a lot of eyeballs on it. Just like a good destination on a road trip, we want to have a good destination. Why? Because we want to have a lot of things to do, right? I don't want to go to a one stoplight town where there might be a bowling alley / skating rink / I don't know what else you could throw in there, bingo parlor. I want to have a lot of different things to do. I want a lot of eyeballs, see a lot of different things. And that's what I mean by a good destination. And when we're talking about a good destination here, going back to our Johnson & Johnson example, we can look at it as a good destination as the underlying, when it's greater than $100, this is going to be one of the rules that we're going to be looking at. If an underlying is greater than $100, we just move the decimal 3 ticks to the left, all right? So in this case, it would be about 15 cents, all right? So then we look down here at the option montage, closest to 35 days to expiration, and look at these strikes that are just out of the money, maybe into the money. I'm not talking about these ones that are deep in the money, but the ones that are kind of like right around in here are kind of the best ones to keep an eye on. And you can see that I'm fitting that rule of around 15 cents to the bid offer. So that would be then like a green light, all right? So a stock over $100, we want to move the decimal 3 ticks to the left, and that is kind of our green light. So in this case, our rule moving it is a green light. So if we're going with the idea of having a roadmap, that would make that a green light. All right, so it fits the rule. So the rule is a green light. Now, if it's 2 times the rule, then we get a yellow light. So if my bid offers on these options were 30 cents wide, that would be a green light. And 3 times the rule, you guys just walk away from it. 45 cents wide for a $150 stock. There's not going to be a lot of volume and open interest. Yes, you guys can flip over and look at the drop down window and find volume and open interest for a given underlying. Yeah, that will give you a pretty good idea, all right? But this rule really brings into context that there are eyeballs watching this market. There's a lot of free market price discovery going on, which means those bid offers are as tight as they're probably going to get. And you need to look at this rule during the day session, open market operations. After the close, bid offers get canceled, the markets get wider. So this is like while the day trading is going on. And if it fits that rule, it is good to go. If it is a stock that is less than $100, all right, so if we have a stock that's less than $100 now, then it needs to be less than or equal to 10 cents wide, all right? So that's the rule of thumb there. Anything below $50, it should probably be tighter. But again, same thing here. The rule is a green light. Yellow light is 2 times the rule, right? So on and so forth. Okay, so same aspect there. So if it's less than $100, make sure they're less than or equal to 10 cents wide. Stock that's less than $50, you'd definitely be leaning towards wanting it even a little bit tighter than 10 cents. All right, so what is the environment? Remember at the beginning of all of this, I said that this is the thing that is going to determine whether we are buying or selling a strategy across the board, all right? We've come up with an assumption. That's the first thing that comes to mind. We come up with an assumption on an underlying. So we need to look at that underlying to see if there's a lot of volume and open interest. Now we go and look at the environment because this is going to determine whether we are buying or selling an option strategy. So what we want to think of it as, when it's clear skies, it's wide open, you can take your time getting to your destination. There's not a lot of stress, so we can go and have a good time. We can put the top down on the car. We can go and visit all the roadside attractions. We can take our time getting there. We're not in any hurry. But when there is high volatility or storms and there's a lot of tension, when you're white knuckling your drive, you want to get there as fast as you can, right? You don't want to stop and smell the roses and pull off and take a picture outside your car at every state line, you know. You want to just go. You're just like, you know, nose to the grindstone. And how we determine if it's high volatility. Now, I'm going to show you guys a streamlined process. That's what I'm all about, is like, I want to make sure that everybody can flip through this rather quickly. We don't have the time and energy to really dig into all of this all the time, but some people really like to do this. So for you guys that really like to do this, what we want to do is take the current IV, which is implied volatility, which is kind of that number that I was showing you earlier, right? When we were talking about Vega. Current IV minus the low IV. We take that sum and divide it by the high IV minus the low IV. All right. So you get those three basic numbers, and this is for the 52-week process, right? That's what my script is going to show you over there in the watch list. That's what those programs are punching in these numbers to come up with this, and it's called, you know, equals IV percent, which really just means, you know, where is the current IV? Where is current IV? It tells us where current IV is in relation to the high and the low, right? We want to know where this is in relation to the high and the low, all right? Because most underlines will have like it'll move up and down like this, right? And if current is up here, if the current is up here, and this is kind of the range bound area that we're seeing, well, we know up here that volatility is at or near the highest it's going to be. It doesn't mean it can't go higher. It doesn't mean when it's at the low, it can't go lower, but it gives us a good representation as to what those premiums are in the option montage. Are they cheap or are they expensive? All right. So we can ballpark it, and I'm going to give you guys some, I'm going to show you guys, we'll dig into this a little bit further as we go along. But for you guys that really like to dig into the minutia, this is what you want to look at. So current IV minus the low, divide that sum by the high minus the low. That will give you where current is in relation to the high and the low of the range. All right. So why does volatility matter? I mentioned this kind of already. When volatility is low, if we got volatility low and it goes high, that means we make money, right? And when volatility is high, they're really expensive. That's volatility goes back to the mean or back down. What happens to those premiums? Those premiums go down. Remember what we were talking about with that coefficient, the Vega coefficient. That's why it's so important. If volatility for this underlying is super low, we get volatility incrementally go higher, well, those premiums are going to go up. And if we got volatility, that Vega coefficient where it's at the very high, or at, you know, what we perceive as being the high, and it starts going down, well, those premiums are going to go down. Now get those levers and pulleys going. How do I want to position myself, right? When volatility is low, we want to be buying premium. When volatility is high, we want to sell it. Low, we buy. That's why we need to know what the environment is. We need to kind of get an idea as to that implied volatility coefficient. Now, when we're looking at the option montage, this number over here is going to be represented over in the option montage, okay? Very close to it. It's going to be very close to it over there on the side in that Vega column. So 49 doesn't mean anything, right? But 49 in relation to what, in this case, Amazon is, right? We can see that, you know, even at the height of coronavirus pandemic, we got this up at around 70 something, right? IV spiked up to around 70 there, all right? And then, you know, the low down here is probably around 16, right? So that's probably around 16. So you can see that the very low, and that was in 2019. I don't know if we're going to see low volatility like we saw in 2019, unless we come up with a vaccine or something. So, and I don't know that there's going to be anything more unknown than this spike in volatility here. Just to put this into perspective for you, this volatility spike like this that we saw for this pandemic hasn't been seen since, anybody guess it? Wasn't the financial crisis, even go further back, like 1984, all right? Back in the 80s, all right? Before that, it was 1929, all right? So this is what on the floor we used to call a black swan event. Now, obviously, this kind of came up and tested that. Most of the underlyings around are not going to see this. So some people I've talked to is, maybe we take that out of the equation. In this regard, I think that we would keep this in the equation here for this particular underlying. So let's blow it up and go into it for Amazon and saying, this is 72 right there. The low down here, let's call it 16 and a half, all right? Now the current ID right now for this underlying is 49. So we can see that. So we want to find out where this is in relation to this area and this area, right? So in this case, you do that, the current, if you wanted to drill down on it, current minus the low, 16 and a half, right? Take that and divide it by the 72 minus the low. So basically we're finding out where this is in relation to it, all right? Which ends up coming out to around a 58 ID percent, all right? 58.63, all right? So what I really want you guys to take away from this is, how do we know this is high? Well, obviously, if it was trading at around 72, this number would be 100%. So my rule is if it's greater than a 50% here, and you can eyeball it too. Like you can kind of go like this. All right, there's the eyeball test. If it's above that midline, I want to sell up here. So this is your streamline. I want to buy down here. All right. If you're newer to options trading, you could even do I'm going to sell above, maybe 75% and buy below, 25 or 30%, something like that. So you can even stretch that out, and this being, the gray area in here. For me, I have a little bit higher risk tolerance. Anything above 50, I'm looking to sell it. Anything below 50, I'm looking to buy it in this case. All right. So if it's greater than 50%, then we sell premium. And if it's less than 50%, we're looking to buy premium. All right. So that's the rule here for that. Now, here's another example I wanted to talk about with XLK. This is, like I said, the black swan event right here, right? And this is another one. So I think that the black swan event is kind of out of the question. That's my thinking. Now, if you have a different perspective on this, then, I implore you guys to go with your judgment there. All right. This, I think, is not going to happen for the rest of 2020. So in that regard, then I'm kind of thinking I'm looking at from here forward. All right. Another thing, when I told you that other rule for a stock greater than 50, right? We sell, and less than 50, we buy. Well, on ETFs, because it's a basket of goods, I usually say greater than 30 is where I'm going to look to sell it. And less than 30, I'm going to look to buy it. All right. So with that being said, in this case, let's drill down on this a little bit more here. So when we're looking at this one and I strip out that stuff, right, then I'm going to be looking at more at the nuances here of trying to draw in where this line is here and probably somewhere around, let's just call it this line right here. All right. So 50, you know, we could say high is 50. The low is 20, let's just call it 26. All right. And the current is 33. All right. So again, we go through that process if you want to really drill down onto it. And we take the 33 minus the 26, current minus the low, right? Divide that sum by the high minus the low, which is 26. So basically, we've got, what is that, 7, right? Current actually is probably closer to 34, so 7 or 8, and divide that by 24, right? So if somebody's got the math on that, 29. 29, I think I punched in this number right there all the way to the decimal or rounded it up to 34. What if it's 8 by 24 and that's somewhere around 33% or something? So it's somewhere between 29 and 30% on a ballpark. You know, 1 percentage point kind of makes a difference there. So in this case, I'm kind of leaning towards I'm going to look to sell it. You know, and if you have a lower risk tolerance, you might say for ETFs above 50, you can still go with, if you have a lower risk tolerance, above 50 IV%, you're looking to sell it. Below maybe 15, you're wanting to buy premium there just to make sure you're closer to extremes, right? But my rule is just kind of above and below the water because it's always going to want to migrate back. I also can say that it's moving in a downward fashion. I think volatility is going to start coming out of this as we approach the next couple of weeks. All right. So in this regards, I'm going to call it high volatility. Plus, we're heading into earnings. I'll show you guys some different examples here. And those earnings are going to kind of really affect this. Now, we talked about the duration. We've got high volatility. It means we want to beeline it there, take a short amount of time. Well, a couple of things are working in our favor here, right? We talked about this. If we have high premiums, we want to sell those. Well, if we're selling premiums, we want those to go down, right? So we also want, but not only do we want volatility to come out of these premiums to help us out, but we also want who to help us out? Theta, that thief in the night. So if we want to get theta to work on our side, we need to get into a option expiration cycle that is going to behoove us, right? So when we're selling an options premium, we want to exploit that theta. So when I was talking about 35 days to expiration being the wheelhouse, the sweet spot, you know, I usually say inside of like 45 days, less than 45 days to expiration, this is your sell zone, sell premium, right? Why do we want to sell premium in here? Because look what happens to those premiums. Inside of 35 days to expiration, you know, you start on this day, you're going to lose 50% of your premium going down this way. You know, this out here, this is where you're buying, right? You're buying premium. Or you're buying volatility. That's another way to look at it. We always want to be thinking about these premiums as a volatility coefficient, right? That's the main driver of making these fluctuate up and down. You know, theta only affects it to the downside. Yes, directionality is a key component. Yes, it does help a lot to get your directionality right. But catching the volatility at a high or a low is paramount. Like, that's, to me, more important than getting the directionality right. Because think about it, if we bought low volatility and we're directionally wrong and that volatility starts spiking, we can be directionally wrong and still make money. Vice versa, on the flip side, you're selling premium, you can be directionally wrong like I was with the Amazon trade, right? And we see that premium come out. So we can get to a profit target rather quickly that way. So in this case, I've got high volatility, I'm saying, for my underlying. So I'm selling, I'm leaning towards selling premium there. I need to be thinking I need to get as close to 35 days to expiration as I can, all right, to exploit that. So that's what we're going to be looking at in the option montage for this particular underline. Now, let's kind of review all of this really quickly. I looked at the charts. I'm looking at XLK being trending sideways for the next couple of weeks here. I think that the market's going to calm down. I'll show you why the extremes, I think, are out of the question. And I think that the bottom is got a nice support area. So that's what I've done when I'm looking at the charts. So I've got a neutral assumption here. This underlying has high volatility. All right. I also want to lean towards, if I have high volatility, I want to limit that duration. Well, then that's going to lead me to collecting a premium. All right. So let's just take a look at the chart real quick for this underlying. Get back over to here. So in this case, I'm going to be looking at these 43 days to expiration, 8 days to expiration. It's not really the spot month. I'm going to look at the charts. So with the charts here, all right, I'm looking at above this area here is kind of out of the question. I also think that, I've got a support level here at 114. I've got another support level right here at, this is a value area high. It's going to want to kind of act as support. We also can see that lined up with this last bounce a couple of times. So I think that this is actually a support level in there that we're not really seeing. I've got this little volume node right here. You can see that that volume node will have the tendency to act as a magnet. That's where a lot of time, that's where we've exchanged price and volume. And that means that price and volume is accepted at those levels. That usually means that we're going to see volatility come out. It's a comfort zone. So for me, I'm thinking that area is a sweet spot. So I think we're going to stay within that area. So what do I think? I'm going to look at the short straddle for this. Yes, you could look at something like the short strangle, which we'll cover next week. But this one I'm believing that there is, I have a really strong assumption that we're going to stay a little bit tighter, all right? If I was worried about it getting a little bit out of whack and, getting a little further outside of a tighter range that I'm looking at, then I might look at the strangle, okay? But in this case, I have a pretty solid assumption that it's going to stay in a tight range. So what are we going to look at? We're going to be looking at the short at the money call, short at the money put. Now, I want to go a little bit further, and that's what most people, you're going to sell the same strikes, all right? So keep in mind, these are the same strikes. Right? Because if it's not the same strike, then we go from a straddle to a strangle. And this is 50-ish. We want to be as close to delta neutral as we can, right? Because we have a solid delta neutral example that we're going to be trading in the sideways market here. So in this case, when I'm looking at my underlying, I'm going to go in here and look at this specific underlying. All right, I don't want to look at those. I want to get back to the delta, the gamma, and all of that stuff. So XLK, $118 underlying. It is an ETF. So what do I do on a stock over $100? Move the decimal 3 ticks to the left. I got about 12 cents wide to the bid offer. You can see that that's not fitting this rule after the close. Believe me, during open market operations. Sorry, I want to look at the 45 days anyway. But you can see it's not going to fit that rule after the close, but it does. It's basically a nickel wide during the day. So let's, I don't have the snippet of it anymore. So let's assume that it fit that rule. I checked that out during the open market operation. So I want to go about the 50 delta on the calls and the puts, right? Those are the at the monies. So here I'm going to sell the 119th, sell the 119 puts. So I'm delta neutral, right? I'm selling a call, making that negative 50 delta. I'm selling a put, negative plus a negative makes that a positive 50 delta. Well, negative 50 delta plus positive 50 delta means I'm delta neutral, right? There's 0 deltas involved. It means I want it to stay right here. One thing with this strategy is it's hard to collect the entire premium. Another rule for when you're building this out, you kind of want to shoot for around, the ballpark is 10% is the sweet spot. That's good. Great, is 20%. You can get 20% of what the underlying is, which means this would be trading around $20. That is huge. All right. As a matter of fact, we can probably look at Biogen. And Biogen, the straddle I just looked at earlier, let's just go to the 50 deltas. It's got some skew going here. But the 50 deltas, there is your 20%, right? And it's at 100 percentile. You can see that Biogen, they just basically are working on a merger deal. So went through the roof here. So that's an example of what I'm telling you guys. Yes, volatility can go higher than breaking out and break out of those ranges from the high to the low. The idea is here that usually it will stay within that range. Doesn't mean it can't do it. It will do it on rare occasions like this when there is a massive unknown with this merger that they're looking at for their, retinal vascular drug or whatever they're doing their merger on. It's something like that. So with that case, that would be one of those examples. This is greater than 30% of the underlying. So huge example of, those are things you really look for. Those are eye-popping. Those are things that you really have to put your head around and think, okay, this is a time that there is an opportunity to sell premium. I think I'd wait a little bit on this one to see when volatility started rolling back over and take advantage of that, but definitely something to keep your eye on. So in this case, though, I'm going to be looking at, I want this theta component. Remember, we said inside of 35 days to expiration, that's where we're going to be looking at. So we're looking at the at-the-monies, selling the 50 delta, which is the 119, selling the negative 50 deltas, which makes that positive, right, for $10.47. Now, let's put this around. I'm getting a little ahead of myself here, but our break evens on this, we could look at it on the analyze chart real quick. Let's just look at an analyze chart so it doesn't really feel like I'm getting too far ahead of myself. And delete this old serious XLK trade. All right, so we can see where our break evens are here. And the chart is showing me about 10, should be 109-ish to the upside. It should be like, to the put side should be, 108, 30, 57. 108.53 to the downside. To the upside should be like 29.50 ish. All right. So if we go back to the charts, 129.50. Do I think it's going to go? Do I think that we're going to get this massive spike again? I don't know. I don't think that that's possible. There's going to be some major resistance up there anyway if we get up there. And then breaking below this area, I think that we found some pretty good support. I just think that we're going to kind of bounce back and forth in these areas and settle down a little bit. Volatility is going to continue to come out, and we're going to be good. Especially, we're heading into an earnings season here, so a lot of these underlyings, this is another part of the thought process here. I'm getting involved in the options that are right here in the earnings zone. And, it's a mixed bag. Some of these guys are going to do good on earnings. Some of them are going to do bad, but they're going to kind of counteract each other on their movement on this particular ETF because it's a basket of goods. And those volatilities are going to come out, right? So I think the volatilities are going to come out during this earnings season, and that's going to help me during the duration of this strategy. So That's another reason why I'm thinking volatility is going to come out, is because during that life cycle, there is a lot of binary events where we're seeing volatility spikes. All right, so you've got this neutral assumption. You come up with a neutral directional assumption for the underlying. The destination needs to have my rule of, on a greater than $100 stock, we move the decimal 3 ticks to the left, right? Less than $100 stock, then it's basically less than or equal to 10 cents wide to the bid ask, bid offer, right? The environment for this one, we want a greater than 50 IV percent, greater than 50 IV for a stock, or greater than 30 for an ETF. All right, and if you're writing notes down, taking note of this, then basically what you guys want to do is adjust this to your risk parameters. You got a low risk parameter, maybe newer to option, then bump that IV percent. Selling is above, let's say 75, and for an ETF, selling it above 50. All right, I have no problem with you doing that. Just stay consistent with it so that you have the data to go back to and see what's working for you. As your risk parameters get, as your risk parameters go higher, or you have more of a risk tolerance, then you can adjust those accordingly. All right, duration for selling those premiums, we want less than right around 35 days to expiration. No, we want it to be kind of around. I don't want to say less than, but as close to, closest to. Let's just do closest to 35 days to expiration. All right, that's the option montage we want. Those ones that are 8 days to expiration, a little bit too close to the expiration cycle for me. 35 days to expiration, I'm all good with. We're right around 45, so that's as close as we're going to get. Strikes, we want to be delta equal to around 0, all right, or delta neutral. So we're going to be hitting the at the money same strikes, which is pretty easy, right? These are the most important ones for this one. The star, right? Those are the ones. These are the ones that are really going to turn the tables into our favor. These are the ones that are going to make or break our trading, all right? So max profit on this is the credit received. I am not going to try and get that entire credit, you guys. It almost never happens, especially with the straddle, all right? Straddle, you would have to have it, even if it pinned on my XLK at 19 exactly, that would be the only time you're going to get out for almost 0, all right? And that's never going to happen. It's never going to nail it right on. I've never seen it anyway. So one of those is always going to be slightly in the money. Well, think about it. If it's slightly in the money, you have the worry of, with this strategy, of being assigned. Another reason why I like that 35 days to expiration, right, is because nobody really assigns you that far out on an option that goes into the money, all right? It's usually inside of basically 10 days. That's where you got to worry about it. Yes, you get a lot of theta happening in your favor in there, but, being assigned and having to deal with offsetting it with the other options and trying to buy it back, and it's just a headache, okay? So we want to avoid being assigned on this. So get out there around 35 days to expiration. Get out of this strategy quickly. It's a big premium collection, so I'm looking to get out at like 50% of max profit on this, if I can. And I've got some guidelines for you guys that are a little bit narrower too. So max loss is the underlying, basically our short call strike plus the premium, and the underlying, anything above that is becoming our loss. The short put minus our premium, that collection of credit helps us, so it gets us further away. I showed you that on the Analyze tab. and our loss can go all the way to this underlying trading to zero. So there is some risk on big moves here. We'll talk about defining this option strategy as well for people with lower risk tolerance, where we can limit that risk next week. But as for right now, you know, the probabilities are in your favor here. All right, so what are we doing? We're taking XRT, right? We're taking XRT to the 119 call and put, right? On a winner, I'm going to be looking at getting out at 50% of max profit, right? If you're newer to options trading, if you are less risk tolerant, I've got another one for you. You can basically go, I'm going less than 30%, but that makes it a little bit difficult. But on a loss, I'm looking at a 50% increase in my premiums, okay? So I'm going for a 50% premium reduction or a 50% increase in or out. Something else you can look at and write down if you want is days in the trade. This is always a good one, when to exit. If you're 10 days in the trade and you're have 10% of max profit left, or it's gone, you know, your premiums have gone down by 10%, you can think of it that way. Look to get out 35 days, you know, 50% of max profit is where I'm looking at. Anytime I can get that 50% of max profit, that's where I'm looking to get out. You know, you saw that with Amazon. It went nowhere. I got out of 50% of max profit on my Amazon trade in a matter of 3 days. So volatility working in my favor, directionality didn't, but you know, if you can get out with that volatility coming out, that will help you. All right. So let's pull up that option montage again real quick. Last thing, I know I'm going to be keeping you guys out a little bit late. I made up for some time though with the snafu at the beginning, hopefully. All right. So this trade. All right, we've got that volatility. Now we can see, let's just take a look at this real quick. If I've got the volatility currently here at 33, let's just say it drops down 4 percentage points, right? Now let's see what happens. 4 times the Vega, right? Premium, I've sold premium on both of these. So every 1 percentage point now is 32, right? Because I sold a call, I sold a put, volatility starts going down. Well, I lose 32 cents for every 1 percentage point move. And what did I say it was going to drop by? You know, let's just make it pretty, 4 percentage points. Let's just say 4 percentage points. 4 times 30, 4 times 32 is $1.18, right? $1.28. Well, you know, that's going to help dramatically. Just that alone in this underlying, dropping 4 percentage points, that's $1.18. That, or $1.28 or something around that. $1.20, $1.30, whatever. That $1.30 in a couple of days is easily 10%, right? So if it happened in a couple of days, less than 10 days, I've already gotten to that 10% reduction in my premium just on the volatility alone. And every day that goes by, I'm losing 12 cents out of this strategy, right? The 6 and the 6 on the theta, so another 12 cents every single day. You see how this is starting to work in our favor? You know, we can see that this is just a representation of the theta. You can see now inside of 15 days, it moves up to 8 cents, and inside of which I don't really want to get in there, but you can see theta starts ramping up as we get closer to expiration. So that's what we want, is every single day this starts eroding quickly. So that's the strategy I would be looking at. We can look at other examples as well. You know, like I showed you that one on Biogen, which is just a massive premium one. You know, the reason why I didn't pick any of these other ones that are really high implied volatility, you know, like BABA, is it's got an earnings coming up, and it's going to land in my option, right? Option cycle that I want when I'm selling premium. So if I have that happening, right, I've got a binary event in there that's going to make volatility increase. So I want to stay away from that. I want it to be clean, you know, kind of like what we would say is a clean month would be something like, there's nothing going on here. That's a clean month. There's nothing going on here, but you could see it had high volatility. That would have been something where I would want to get involved in around that clean month, right? Another clean area would have been right here. Take advantage of that, right? So I want to take advantage of those clean areas. And right now we're heading into earnings right around the corner, which is the most exciting time of the season, of the quarter. I love earnings season because we get that high volatility and we get the volatility crushes. So I wanted with XLK, I wanted to get out of an earnings for that underlying. Yeah, there's a lot of earnings going on inside of that ETF, but ultimately, I think the underlyings are going to move. Some are going to have good earnings, some are going to have bad earnings, so they're going to offset each other in their movements inside of this ETF. But ultimately, we know volatility will be coming out, right? Because heading into a binary event, which is an unknown, we see volatility spikes, all right? And once those knowns are known to us, then volatility really dramatically comes out. And that's how we can make money. We can see that volatility coefficient really work in our favor. So that's what I'm going to be looking for in this particular trade. So one thing I also forgot to mention, I implore you guys to do something set up like this where you write it down. I know where my winner is. I know where my losses are. I know what my write down, all of those things where I was talking about that you got this, the destination and all of those things working in your favor. I just messed it up. This page, like go through, like make that your checklist, if you will, where I've got my direction. You say I'm market neutral, and you write that down. I'm neutral, right? Destination is XLK, all right, and it checks off the rule. The rule checks off the environment, where exactly your implied volatility was, right? That in relation to the underlying, because that might help you judge. Hey, I have a higher risk tolerance, and I've been using just above 50, and now I don't like how my probabilities are working out. I'm going to move that a little bit higher and see how those strategies implemented around a higher implied volatility percent work out. They're probably going to work out a little bit better. You are going to have less opportunities, though. That's the other thing. Keep that in mind. Duration, what your duration was, and your strikes, all of that stuff. The premium you collected is important as well. All right. You guys have any other questions? Pretty simple, though, for setup. We're doing the at the monies. The keys I really want you to take away from this is selling volume volatility when it's at its highest, or we expect it to come out. All right, that's another thing, is you expect volatility to come out. We've got a market neutral assumption. I think it's going to stay right here. The duration, I want to take advantage when I'm selling premium. I also want volatility to come out, but I also want that theta to work in my favor. I want it to help me out, all right? And our strikes are basically, we want to be about delta neutral with the strategy. Oh, I know what I wanted to show you guys. The other thing is we talked about probabilities earlier. So with this particular strategy, I'm talking about, we talked about the probabilities of being in the money, and like, this, where's XRT or XLK? Why do I keep doing that? I got it stuck in my head, XLK. So when we're looking at this $10 premium, and we talked about the break evens, we can look at where our break evens are on the option montage, and this helps us get a good idea as to where we're going to be. So 129.50, so basically 129 is my probabilities of being here, or is where my break even is, I should say, somewhere right in between here. Well, my probabilities of that happening, of being in the money, are only 21%. So pretty low probability of it finishing in the money here. And to the downside, 109, 108-ish area, about 23, 22% probability of that happening. Pretty low probabilities, which means that our probabilities of staying in between here are pretty good, right? We've got a pretty good probability. We only have 20% probability of it going to our upper limit, to our break even, and a 21% probability of it going down to our lower break even, and settling there, like being in the money, like having to worry about breaching our break even. Really is what I'm worried about there, right? That's the most important thing, is worried about where my break even is breached. Another thing to keep in mind is 2 times the delta is the probability of being touched. So within the next 43 days, keep in mind that 129 has about a 40% probability of the underlying coming up and hitting 129. There's also 2 times the probability of the underlying going down and touching 109, all right? So that likelihood of during this duration that the market could come down there and hit one of our strike locations is 2 times the delta. The delta tells us the probability of being 1 penny in the money at expiration, right? So low probability of all of those things happening. Higher probability of us staying within there. We can look at it. There's a 60% probability that's not going to happen, right? There's a 60% probability we're just going to ping back and forth in between here. And I'm just going to watch theta and volatility eat away at those premiums. Okay? That's what I want out of this strategy. Staying neutral, volatility. And when you stay neutral, that volatility will have a tendency to come out. Right? Any other questions on that? I got to pull this up because I forgot to do something real quick. Let me get to this. I don't see any other questions. No? All right. So, well, there aren't any other questions then. Oh, I got the wrong one up now. All right. So this is the offer. Like I said, we're in the middle of earnings season. This is something that you guys are going to want to take advantage of moving forward, because what we're going to be seeing here is options trade, earnings trades. I mean, that's really the only thing that you're going to be able to trade coming up. You don't want to be trading options any other way during earnings season than the way I've kind of got it set up for you here. So over in the chat window, I'm going to drop this link into the chat window. So you can click on that link there. I did it twice, I think. Yeah, it's in there twice. So in the chat window is the link for this. It's a hot link. You can pull it up and see everything that goes into it. But this is how to set up your trades for earnings ahead of time. Lower your overall cost base on it. Take advantage of volatility expansion. How to protect your portfolio during earnings. Also getting ready for the next earnings cycle. So we're going to start seeing these earnings come and go. We can set up for those earnings that are down the road right now. So that's how we're going to trade that. And I'm going to show you how to do that in this course. So make sure you guys take advantage of it. For $36, you can't beat it. One missed opportunity or one trade setup wrong for earnings, like you'll listen to the people that I quote in these webinars out in time. They, the people on TV don't always have the right option strategy is all I can really tell you. And if you follow my guidelines and understand my thought process for implementing options, you will absolutely be able to look at these guys and be like, why are you buying volatility? Why are you picking that strike location? It's just not going to make sense, all right? And that's what I try to talk to you guys about in these courses here. So $36. If you're listening to this, it's going to save you the time and hassle Yes, online it is free a lot of times, but I'm telling you guys, I've learned from having on the floor, we used to call it, we got stuffed with trades. That meant we had to take trades on that we didn't want. And that was from basically, we were the guys like on TV that are stuffing you with trades you shouldn't be putting on. You're going to learn from those mistakes, like why, oh my God, why did I put on that trade now that I've heard Wolfman talking about how the premiums are going to react to this kind of situation? I should have known better. Well, for 36 bucks, that's less than one bad trade. All right. So please take advantage of that. Your education is what's going to get you further down the road. Plus, I'm going to help you guys stay mechanical. We want to take the emotion out of trading. That's the only way to be a great trader, is take that emotion away. And if you can follow a process, right, you can be mechanical, put the blinders on to all the noise, all right, you're going to be a better trader, all right? You're going to be able to follow a process, checks and balances, stick with it, keep your powder dry, you'll be a better trader. Once that emotion seeps in there, and emotion usually is because we correlate this to money, we want to take that away from it, but also not knowing really what we're doing or why we're doing this. I explained to you guys in details the levers and the pulleys, so you can see how the inside of that watch or the cogs are moving in correlation to one another, right? They're not moving in opposite directions, right? Maybe you notice I've got that. Anyway, I used to do this one, going in opposite directions. Those would be banging into one another. That's what's happening when you don't have the known going on. Oh, I think I took off my video camera so you couldn't see that. I'll throw up the video camera for you. Can you guys see that? It's going in opposite directions. All right. All right. Anyway, so that's the link in the chat window. You got that. Make sure you take advantage of that. If you're watching it on tape delay, you're going to have to punch this into your URL. That's all I got for you guys. Thank you guys all for sticking around. And other than, if you can't take that, oh, wait, before we go, take it easy, pal JQ. Good to see you. I saw you come in early. I do have to, before we go away, make sure you guys understand your risk parameters and understand the risks of trading, which is all outlined in this disclaimer. So please take a moment to go over this. And I'm sure you've heard that before. All right. So if you can't take that, take it easy.